afternoon. Welcome to Adelaide Capital's first webinar with ROK Resources. ROK trades under the ticker symbol ROK on the Toronto Venture Exchange. They also have freely tradable warrants that trade on the TSX.V as well, with a strike price of 25 cents. ROK has had a busy 2 months completing a company-changing transaction, an oversubscribed $17.3 million prospectus offering unit deal, and a $65 million term debt facility. With us from the company today to discuss their background and recent milestones is Cam Taylor, Chairman and CEO, and Bryden White, COO. After the presentation, there will be a Q&A period. Please enter your questions in the Q&A box or email me at jessica@adcap.ca. As always, the presentation may contain forward-looking statements. Welcome, Cam and Bryden.
Yeah, thanks for having us.
Yeah, welcome everybody. So ROK Resources, welcome to a new name in the public oil and gas markets. We're a team that's been working together for the past 15 years, but we are a new name on the public markets. So looking forward to introducing you to our story, who we are and what we're doing. So the three co-founders, myself, Bryden Wright, who's on the call with us, and Jared Lukomsky, our VP Land and Business Development, started this company back in 2018. We took it public right at the end of 2019. A team that's been with us, as I said, for 15 years, working in Southeast Saskatchewan, building and growing private companies. We're excited to be in the public space and be able to tell our story to a wider audience. My history originally, prior to focus in Southeast Saskatchewan that started in 2001, had been spending about 12 years in the Deep Basin and foothills working on a variety of natural gas plays in the multi-zone areas in Alberta. And that's certainly experience that I'm getting to apply again here on this new set of assets that we've picked up. But I just wanted to emphasize again that our team has been working together here for a long time, primarily focused in Southeast Saskatchewan. And I wanted to just walk through that history with you a little bit so that you can understand the experience level that's behind this team. So there's four companies that I want to talk about. Villanova Energy Corp was a Bakken-focused company, drilling and fracking in the Bakken. Spent 2 years building that production up to 2,400 BOE a day, operated the two rigs, sold that company to Crescent Point at the very end of 2008. And as we sold that, we had recognized that the Bakken land was getting very busy, very expensive, but we felt that there was a good opportunity to deploy that 1 mile long drill and frack technology to the Midale. We'd been working in the Midale down dip of the big pools, and there was some exploitation difficulties, 5 different zones, hard to exploit conventionally. So we took the drill and frack to the Midale, started in the Steelman area, built up a good land base, started drilling. We made it about a year when Legacy came around. They were starting to consolidate assets and wanted to get into the Midale drill and frack, and bought us out after about a year. We'd made it to 1,000 BOE a day at that point. We moved down south a little further into the Pinto area and carried off the same business plan. Got that to about 1,600 BOE a day after 2 years. And the same thing, Legacy came along and wanted to purchase that as part of their growth strategy. Sold to them, moved over a little bit to the east in an area we're now working again, Glenue Cardiff area, and we built up a Villanova 4 Oil Corp, and just about had that at the 1,500 BOE a day range when oil prices collapsed in 2014. Hit the pause button, moved into the Frobisher, which was a little lower capital, quicker return, and I'll show you some of those economics here later in the presentation. We're able to work our way back up to 1,700 BOE a day and sold that in July of 2018 to Torque. And so I think the messaging for me that I take out of this is, really our team's focus has been on building organically from 0 to 1 to 2,000 BOE a day, and had traditionally been funding privately and selling into the public market. During all that time, pretty much steady, kept one rig busy, building facilities, usually as an operator. So very high capabilities in terms of operational workload, and operated a lot of wells, a lot of facilities over the years through the course of these 4 companies. Created a lot of value, and really excited now to take that to a new set of assets and use those skills again. So one of the reasons for moving a little bit into the acquisition side to start is wanted to get our hands on a high volume of high quality assets, which we've done now through this acquisition. It generates a lot of free cash flow, so we're able to fund our capital program out of cash flow. And it's a good position for our team to be in. We're very excited now to get back busy with the drill bit, and we've got some great commodity prices to work with now. So very exciting next few years ahead of us. Just talk a little bit about this transformational acquisition. So we spent $72 million. That was funded through a $65 million debt instrument and $17 million bought deal equity raise. And that resulted in a set of assets. Just summarize here briefly. Southeast Saskatchewan, our sort of home hunting territory here, we were able to pick up 1,500 BOE a day. And it's interwoven with a lot of land and facilities that we already have. The crown jewel in this is the 2.1% share in the Weyburn unit. This is a CO2 flood unit that really is one of these blue chip assets that rarely comes available. So we're very excited to get our hands on an asset like this. The unit operator is Whitecap. They own 65% of it. They've presented to the unit holders their 5-year plan, which is to expand the CO2 flood and grow production. So this is one of these very rare animals, the inclining asset in oil and gas. It's beautiful to have an asset that's going to grow. This 460 BOE net to us should grow to 505 BOE according to that plan. And the reserve life on this property is 40 years. It's an incredible property. In addition, it allows us to inject enough CO2 that it covers, the CO2 injected covers off 86% of what we produce as an entire company. So a very strong CO2 injection story to go along with that flat production. In Southwest, we've picked up 460 BOE a day. We operate half of that. It's the upper and lower Shaunavon. The lower Shaunavon will go into water flood. The upper Shaunavon has additional drilling locations. Directly offsetting our 100% operated interest is a non-op interest, a unit that Whitecap owns. And they have the same program in place. They're busy pressure supporting, and they're drilling the odd infill upper Shaunavon well. So we expect this asset to grow incrementally over the next 2 years. The Kaybob asset it's a new asset for our group. It's an area that I'm very familiar with from my past life, but exciting area because of its multi-zone nature. And 1,000 BOE a day coming out of that area. This is an area that we have both exposure to both oil and gas and good growth potential in both. A lot of infrastructure in place there. Very strong area, surrounded by Whitecap and Paramount in that area. Just a quick look at the market cap. We have 188 million shares outstanding, 141 million warrants. Management and directors hold 15.4% of the company. So very strong alignment with our shareholder base. And philosophically, that's something we bring from our private equity world, a strong belief in owning shares beside our investors. And we'll continue to do that. Just a bit of a look at the warrant package. None of these are performance warrants. They were all issued in conjunction with issuing of shares in raising money. There's a group of them, 12.5 million shares that'll expire here in June, July of this year and bring in close to $2 million. The remainder of the warrants are 30, 35, and 25 cents. So this acquisition took us from primarily an undrilled acreage base with a few key facilities, through the acquisition into a company doing over 3,000 barrels a day, net operating income of $63 million, and a very strong netback, $53 per BOE, including our gas position. So very strong position. The strategic rationale for this company really is to take that $63 million of net operating income, supported by a 24-month hedge that we've been able to lock in at what amounted to the highest oil price in 10 years. So very good timing on the lock on the hedge. And we'll deploy that against this 350,000 net acres that we now have to explore and develop. And we believe that's going to result in a great growth story here, very low cap growth story that's going to provide a lot of torque to investors. I think it is worth spending a little bit of time just looking at this hedge program. This is 24 months. You can see the kinds of prices we were able to lock in at WTI 113.102. It amounts to a $104 average for the remainder of 2022 on WTI and a $94 average over the 24-month period. So very strong financial position for this company to move forward with. If we take a look at how that shakes down sort of through the company, $738 million of revenue. Once we take off the royalties and op costs, $354 million of net operating income. The ARO requirements, we have just a little under 20 million of inactive ARO requirement, which we can handle very easily with our cash flow and through the course of this next few years of development, we expect to decrease that very quickly. Coming out with $191 million of cash flow through the payment of interest and debt, $114 million of value on the $17 million of equity that we raised. We think it's a very strong position that the company's in and a very, very good price for this acquisition. The reserves, we have just completed and press released an updated reserve report. McDaniel's consolidated our previous reserve reports and the existing report to give us an effective date, March 31st effective date, March 31st pricing. Come out with $114 million of PDP value, NPV 10, $143 million on the total proved, and $225 million on our 2P. So I've taken a snapshot here of a small part of our Southeast Saskatchewan assets, but it's an important part because we're about to start drilling in this part of our asset base. And I thought it was important to understand not only the big land position that we have, not only in the Midale, but in the very lucrative Frobisher formations. And these are areas we've been actively drilling in since 2009. We know all the players. We operate down here on a steady basis over the years. It's really our briar patch, very comfortable down here. And one of the reasons that we're so set on this particular set of plays is the economics. So at $80, $90, $100 WTI, we can invest a little under $1 million in these wells. And based on the engineering report type curves, which are typical of our results in this area over the years, we're able to bring out an NPV 10 that ranges from $2.6 to $4 million on each of those wells. And so that's peaking out at $100 WTI. The rate of returns over 500%, payouts 3 to 5 months, depending on that price deck and results, of course, and recycle ratio 4 to 6. So these are incredible economics. They let us deploy some capital and get that money back very quickly to use again. Kaybob area, this is a very exciting area for us. Green are the lands we hold, multi-zone, lots of different rights, but two key plays to keep an eye on. The Cardium, this whole area right here is the Cardium D pool. That area is dominated by Whitecap. They're drilling all around. We've got 9 booked locations in there, and we'll be in there drilling in January of 2023. Very light oil, lots of well control around, not many surprises. Very good economics for us once we get into this $80, $90, $100 WTI. You can see that our NPV 10s per location range from 1.5 to 3, recycle ratios 2 to 3. So very good oil play for us. Another Cardium play developing in the south that we've done some perf and frac of verticals and just testing that. Expect to be in there drilling in January. Big white area in the middle of our lands in here. This is Paramount's Kaybob South Montney area. Very big results in the gas, anywhere from 10 to 12 BCF cumed out of these sections to date, still producing strong. We have a number of verticals that have produced a lot of gas out of the Montney in this area. We believe very similar geological parameters, and it puts us in position in the future as we take a look at these gas prices to deploy some capital and increase our gas production in the area. We have a underutilized compression facility down in 431 that we're able to use. We have pipelines throughout the area and a set of operators. We're 100% operated working interest in the block right here. Also some blue sky and Dunvegan oil that's coming to this area and has been recently drilled by us and our partners. So I think that summary is really leading to what I hope people will see as a good buying opportunity, a very good value. Our enterprise value to net operating interest and cash flow puts us in a very strong position for a small company, especially. If we take our unhedged volumes and assume a $90 WTI, we'll deploy $16.5 million in 2022, and we'll pay our debt down to the tune interest and debt repayment, $27.5 million, leaving us with 14.2 of free cash flow. And even if we take that unhedged volume down to $60 WTI, we're still sitting in a free cash flow position. So financially, we're very strong here, able to pay our debt down and execute a good capital program, create some growth and some optional free cash flow. So I think it's a bit early in our life cycle to be comparing ourselves to Headwater or CNQ, but it is interesting to just see where we sit in some of these important free cash flow yield, debt adjusted free cash flow yield, just to see where we sit and what we look like in a value comparison. Again, we're very small, low end of the market cap, hopefully be growing that here over the next couple of years. But I think it's just in its own right, off of its production and cash flow, a very good value for anybody wanting to be exposed to the oil commodity. So again, some extremely high quality assets. I've been so excited working through this last 2 months now on these assets, and with the new staff we picked up, a lot of running room on these plays. New commodity prices to work with means we're going to turn a lot of production back on. A lot of great drilling opportunities for an organic growth focused team like ourselves. This is just kids in a candy store. Very exciting. A lot of free cash flow here to work with as well. So certainly not starved of cash, and a lot of money that we can take and deploy, both in terms of paying the debt down and growing this asset. And then even though we're new to many of you in the public markets, this team's been operating together, very tight team, good field operations staff, used to running rigs steady, very, very used to high activity levels. And I think we're a great team to be sitting on these assets. We just released this consolidated reserve report in April. So that's sort of a first catalyst for the market to understand who we are and where we're going. We should see just some housekeeping to clean up that year-end financials for the ROK pre-acquisition. That'll come later this week, hopefully, and we'll be able to announce little firmer budget plans. Going to see a drilling program, a 10 well-operated drilling program start in May. So coming up here shortly, focused in Southeast Saskatchewan, lots of really good growth opportunities there. So I'll be excited to report back on that. And then in January of 2023, we'll get started up at Kaybob with a drill rig up there. So I think very exciting catalysts here certainly over the next 12 months. And appreciate everybody taking the time to listen to that story, and we'll take some questions.
Thanks, Cam. I'll start off quickly, and then we do have some questions from the audience. After the 4 successful private companies you built and sold, what made you want to enter the public markets and all that comes with that?
Yeah, there's a lot of extra administration. So for sure, it's a decision you make very deliberately. But during the period we ran those, built and sold those 4 companies, there was a very aggressive acquisition market in place. And so we started each of those companies with a 5-year plan to build an asset base and grow free cash flow. And inevitably, we were bought in 1 to 2 years. After the collapse in 2014, that liquidity event went away. Really was no line of sight to liquidity for private investors. So our money had been raised privately and investors relied on a liquidity event. So it was very clear to us that in order to get out ahead of this next commodity cycle and get some assets and get positioned, that we really had to move to the public market space in order to provide shareholders with some type of liquidity. So, it was really driven by the market. Our need to get out in front of this supply-driven high oil price cycle and just access of capital. All of the private equity was frozen waiting for liquidity events. So no choice really.
Okay. Thanks. Given your knowledge of both these areas and your success in these areas, have the FCL assets been on your radar for quite some time? I know they've been for sale, not for sale, and then it did come down to a competitive process. Have you been sort of coveting them for some time?
Yeah, for sure. So some of those assets were assets picked up from a company called prowess that we were actually partnered with on many of the assets. So we've had our eye on these assets since back in 2008, 2009, when we were partnering with them. I guess the core of the assets that we were after, they were always right beside us and had some great facilities and undeveloped land. But FCL made a decision in 2016 to sell the company and unfortunately got a incredibly overvalued engineering report, which sort of froze the board. They weren't able to sell for market price. So that asset has sat without significant capital investment now since 2016, just the odd maintenance well. But we've been coveting that asset for a while. We went after it preemptively in August. Inevitably, the company decided to go to price discovery and a process, and we participated and won the bid. A few little hiccups along the way, but we were able to close it on March 7th. And we couldn't be happier. It's exactly what you want as an asset that's had a lot of wells shut in through low prices and not much drilling activity. So we're excited to get to work on it.
Just building on that, the fact that these assets have been somewhat capital starved, do you see a lot of opportunities for workovers, things like that? And how would that impact your ARO?
Yeah, there's a big opportunity for workovers. There's a lot of oil that got shut in just because of water cuts or a broken rod and different things that money just wasn't invested to bring that back on. Maybe, Bryden, if you want to speak to just how you think some of that inactive ARO will be impacted by that.
Yeah, absolutely. So we've identified about 25 gross locations between the two provinces that have the ability to be reactivated. And so we're working through that budget and that timing. But in the event that all of those were reactivated, that would reduce it by an additional $1 million plus on the inactive side. And then in addition to that, we're working on some other environmental reclamation certificates to reduce it by another $2 or $3 million. So, our goal is to, on the ARO side as a whole, is to reduce that inactive ARO. We're going to spend about $1 to $2 million a year on that program. We're going to utilize the funding of the ASCP that's in place today, which is about $800,000, and we're going to actively focus on that reduction. So, between actually, abandoning and reclaiming wells, getting certificates, and then reactivating wells, our goal is to reduce that, in a 5 to 7 year timeframe.
Someone from the audience here, how much undeveloped land do you have at this point?
I think it's around 50%. I know in chatting with Jared, that was the last number he had given me.
Okay. And how many unbooked locations?
it's over 100, but I don't have a hard number on that. The Kaybob area is interesting because we have 8 producing zones there, and we've gotten through the Cardium, the Montney, Blue Sky, and just working our way through some of the others. So give me a bit of time on that.
Okay.
I'd add a note to that. I've worked with, all the reserve evaluators, and we've used McDaniel on this latest one. And that's who FCL used in the past. I think they're quite conservative on their bookings. I don't think they like to overbook any, areas. And so there's 12 Cardium locations booked. I think there's potential for 50 locations perhaps, up just in the Cardium. And that's gross, of course. But, and then in Saskatchewan, I think we have maybe 25 to 30 locations booked. So again, it's quite conservative. And I think, part of the focus of our drilling program is to add booked locations. We're not just going to convert PUDs and probables. Our goal is to add locations.
That leads me to what I was going to ask you on Southeast Saskatchewan. You're going to start your drilling program the end of May. So we'll see development and some exploration opportunities there.
Yeah, for sure. On that 10 well program, there's 4 wells in particular that set up a fairly significant follow-up drilling program. So, part of our strategy there is to drill wells that are going to extend the pool boundaries and add additional locations. And I guess our strategy in the past has been to work off from existing facilities like that and just risk reduce additional locations and just keep that conveyor belt going.
Okay. Obviously, if successful, do you think you'll increase your capital in this area if oil prices stay static?
Yep, for sure. I think Southeast Saskatchewan has a lot of growth potential in terms of capital spending. We're sitting on a couple of really good water floods that require a little investment, and a couple of wells that have water floods that have already been designed and one of them approved. And so there's a lot of room there for further investment. I think we are going in here and aggressively tackling wellbores that we think can prove up additional locations first and deploy our capital that way. And yeah, I think Southeast Saskatchewan, there's a lot of money for us to spend there in the future.
Okay. And given that, do you see with the assets you've just acquired and the M&A activity that's happening right now, are there opportunities for you to sell, swap, acquisitions you're looking at?
Yeah, absolutely. There's one of the characteristics of this asset base was a number of non-op properties, and we've got our eye on a number of them that we'd like to trade. There's properties, for example, at Workman, where we have a variety of unit interests shared with Vermilion. I think there's a great opportunity for consolidation there. And in some of the other areas, we've identified trading pieces that we think we'll go to work on. So yeah, I think there's a lot of opportunity for us to do some consolidation over this next couple of years and divest of some of the non-op interests and consolidate some of the higher working interests. So that'll be an important part of just sort of cleaning up this asset for sure.
Okay, so if we move to Kaybob, what kind of gas price do you think you want to see before you determine whether or not you focus on more of the Cardium oil or the Montney gas?
Yeah, that's a great question. We have a lot of stacked zones and reperforations we can do in our existing wellbores that will work at every price. I think if we look at the Montney, though, the engineered locations there show a change. The NPV 10 of those go from 3 million to 8.5 million as we go from $4 to $6 gas. So certainly anything above $5, gets really tempting for us to start drilling Montney wells and utilize that capacity. I think early on, we're just going to be sensitive to where do we get the best bang for our buck. We've got a lot of optionality here. Obviously, paying some debt down is a key focus for us, but we have a number of light oil locations that we can weigh against the gas. If we looked at the AECO strip for the next 12 months and you see gas sitting averaging around $6, that's incredible economics on those Montney wells. So it'll be hard to ignore them, but we'll keep an eye. One of the key things for a company like this and this kind of asset base it sets up all kinds of optionality for us. We'll be sitting with the 5 Montney sections that we have 100% operated. There's 20 Montney locations there ranging in value from 3 to 8.5 million. So that's a great optionality to have to run through an underutilized compressor system. And right beside that, a bunch of light oil in the Cardium, and then all of our light oil in Southeast Saskatchewan. So, when it comes to this fall, we'll be taking a strategic look at that and just see what these oil and gas prices look like and make some smart decisions.
Yeah, it certainly looks like you're inventory rich. And so that'll lead me to a couple other questions. You've had a very successful hedging program so far. How do you see that going forward? If you do see $6 forward strip gas, do you lock in there? Or do you want to keep just what you have in place right now?
No, I think as we roll a month off, we'll roll a month on terms of our hedge until we've got very clear line of sight to that debt being repaid and our initial capital program executed. So as we roll off April, we'll roll on another month. We'll keep 24 months ahead of us for now. And we've got another decision to make. If we do enter into the Montney gas, then I think you'll see us doing some drilling and then locking in some hedges after the fact and protecting some of that cash flow. So I really fundamentally believe in using those hedges to protect debt repayment and the sort of the key capital program. So you'll see us continue to do some hedging going forward.
Okay. Let's talk a little about your term debt. It's with Anvil Channel Energy Partners, which I don't think a lot of people are familiar with. So if you want to discuss the terms of your debt, and we have one question here. If you pay out your debt early, does that mean you only have to pay the interest on let's say you have your debt for 3 years as opposed to 4 years? Or do you have to pay the entire 4-year term interest?
No, there's no penalty for repayment on this. So one of the things we liked about this particular loan structure, so it's 8% plus prime. So today that's an 11.5% interest rate that we're paying. The financial group that organized the loan, rather than use any dilutive warrants or any payout penalties, they took a GOR 2.5% for the first 4 years and 1.5% going forward after that. But that left us in a position where we have the ability to pay that debt out at any time. So there is no penalty for early payments. So we have a fairly aggressive debt repayment schedule, almost 40% in the first year between the payments and the sweeps, and a little over 30% the following year. So our intent is to get that paid down very quickly, and our belief is we'll be able to pay that down by the end of the first 2 years. So that's how the cash flow looks to us today.
Okay. If you saw material increase in commodity prices, would you utilize that just to pay down debt, or would you increase capex and pay down debt?
The devil's in the details in that question. For example, Montney at $6 gas, the quick payouts and the big value creation on both the reserve book and on the net operating income, you definitely need to deploy some capital towards that. So, I think the answer is all of the above. We would definitely use it to accelerate debt repayment, but we'll be at high prices. If we're sitting in the above $100 WTI and gas above $5, then definitely we're going to want to be able to show some of that or turn some of that capital towards growth.
And speaking of growth, I know you haven't come out with your budget yet, but what do you think is a reasonable expectation for growth for this year on your asset base? Yeah, if you're willing to give that number.
Yeah, it's, without having everything finalized, it's hard to get too specific, but we certainly expect to be, over 3,000 BOE a day, 3,300 BOE a day at year end. There's no Kaybob drilling at that point, so there's nothing really happening at Kaybob besides workovers, et cetera. So a little quiet on the Kaybob front up until year end, but we will be doing some drilling in Saskatchewan, and that's what we're expecting is fairly modest growth and really looking for some of this early drilling to set up a fairly significant additional drilling program in Southeast. So
you feel like you have quite a bit of running room on these assets?
Oh, yeah.
Without having to do any acquisitions. That said, you probably do some smaller tuck-ins, I would suspect.
Yeah, we're evaluating some of those right now.
Speaking of which, what kind of price points are people looking at for smaller names? I know there's a lot of PE funds that are trying to get off stuff they've been holding for 7 or 8 years that they, for 5-year funds, that kind of thing. Are you seeing reasonable prices being asked for some names, or are people out to lunch on their pricing?
I have not got far enough down the road on a couple of these negotiations to be able to tell you that answer. I think we've seen a lot of things trading at PDP value or below that. And of course, PDP value has been running away sort of between letter of intent stage and closing. The PDP value's gone up and they end up closing at 80% PDP value or something. One of the real dangerous things about a time like this is the buyer and seller's sense of value tends to drift apart, and it can be hard to close that gap. So, I think what we've seen historically, production selling for, it's a new game now. There's a higher netbacks, higher commodity price expectations. But I can't answer that question about, where buyers and sellers are going to agree. Sometimes you can end up in situations where, despite the fact that we've seen, private equity investment frozen for 7 or 8 years, there's a massive desire to see liquidity from those private investors. It can be hard to sell at a low cash flow multiple. And so, I think this is really where it comes down to being able to sit down for ourselves, being able to sit down and talk to the shareholders and explain to them how much growth they're going to see on this stock of ours, and be able to negotiate something that's a reasonable price for both parties. Accretive, our interest is to do deals that's accretive to the free cash flow per share. And as long as we get there, and hopefully we convince the buyer that they're in for a exciting ride upward with our stock, then I think we'll get some deals done here. So
there's a lot. You're finding willing sellers to take stock as opposed to putting more debt on the balance sheet or doing an equity raise.
Yeah, that's the read that I'm getting right now. Both cases, these bolt-ons we're talking about are absolutely willing to do that. So,
okay. And would there be a lockup period, would you think, on those?
I think there has to be a. One of the tricks to doing those deals is you've got to give people enough cash for cash or liquid shares to meet their short-term needs. But yeah, on the bulk of it, there has to be some lockup there to just give us a little time to show some growth and build a good market following in behind.
Okay. One person is asking if your NAV per share, why you didn't deduct the debt off that.
Yeah, no, that's a good question. We should have done that.
Yeah. Okay. And then just one other comment here. Can you comment on the number of outstanding warrants and its dilutive effect?
It's massive, and it's that's the reality of doing deals in the environment that we did this deal in, and certainly wish we had half as many warrants out there, but that's how many warrants we have. So I think that despite that, this asset base and the cash flow and the amount of value there, still an incredible buy at these prices and a lot of room to run. But yeah, absolutely. Wished we had fewer warrants.
Well, I think you said the process was competitive and you kind of had to take money you could win.
Yeah, that's right.
So what's your vision now for the next 1 to 3 years for ROK, DC?
Yeah, it's exciting. It's fun to be off and running with a great asset like this. So first and foremost, we're going to pay that debt down very aggressively. We want to get as quickly as possible, and hopefully by the end of the second year, we're there where all that free cash flow is in our hands to use for combination of capital program and growth and returning to shareholders. So I think getting that debt paid down is going to be a key focus. Parallel to that, though, we definitely understand that a 3,000 BOE a day company is a bit small for this public market, and we're going to be focusing some capital on growing that. And it's a specialty I guess we think our team has, is that organic growth model has been something we've been operating with for a long time, and taking a bunch of that free cash flow and growing both the reserve report, the net operating income, and the location base. That's a key focus for us over this next couple of years as well. So sort of two parts, and I think we have ample cash flow thanks to the hedges and the price decks that are out there today. So I think we can achieve both of those goals. So, if you ask me to look 3 years from now, I think we would, through that organic growth and some additional acquisitions, we'd be twice the size that we are today, and debt-free, and a lot of free cash flow per share.
Okay. I missed anything? No, I think we covered all the questions I had and the audience has. We're really excited for you guys to be in the public markets. We've known each other for a lot of years, and so It's exciting to be able to get involved with these assets. Just one last question: do you think feasibly you could grow them by like 30% just organically?
Yeah, my look at this, I strongly believe that with what I'm seeing on our current asset base, that we have the ability to get this to 4,000, 4,500 BOE a day. Obviously, there's some prices that need to be in place to go and do that. But with the price decks the way we see them today, and our asset base, that's what I believe we can achieve out of this asset base. It's up to us to go and grow that out a little more, both through acquisitions and some additional grassroots exploration stuff that, when I say exploration, really for us, that's largely been just pushing the boundaries, areas where we own facilities, just taking a look at these new prices and what's possible. And we've always been good at doing that. So we'll keep doing it.
As far as downside risk, the commodity price, is there what price do you guys sort of hold back on your capex, do you think?
Each play's different. My belief is so strong right now that this is a massively undersupplied oil complex right now. The lack of investment from 2014 till now, it's just not possible to keep worldwide production cranking at the levels it's been with that little investment. So I'm very bullish. So I think as soon as we drop below $80 WTI, I'm starting to think about cutting our capex back, because I really don't believe it's long-term. There's a lot of plays like the Frobisher that make good money all the way down to $40, $45. So you can certainly keep spending your money and cycling through locations, but that wouldn't be my instincts in the short term. I'd be, I'm a believer in this commodity cycle, and I'm trying to build assets and produce oil over $80. On the gas side, I maybe have less sort of experience and clarity on that, but largely with the gas, it's about keeping our op costs down, picking off the low-hanging fruit, and then in terms of recompletions and into existing wellbores. But yeah, certainly once gas is down below $4, the Montney's going to be drilled. Okay.
Is there anything that I've missed? What's your biggest challenge, do you think, today?
I think it's going to be costs. We've booked a rig, we've booked steel, and we have a really strong network of field staff. So I think we're in good position there. The assets are good. I'm really interested to see what happens over this next 2 years, the way that pricing is shaping up to be. And as we stand rigs up and service rigs and, start using supplies again, I think managing that cost creep is going to be the biggest challenge. And so a lot of that is about being proactive. We're very aggressively planning our winter drilling program in Kaybob right now so that we can make commitments and book. And a lot of it is about getting out ahead of things, largely planning and scale efficiencies. And when you're a small company, it's not scale that you can run all the time. So you have to organize into programs and do things in bursts. So yeah, I think cost is going to be a big challenge.
One more question that just came to me. Would you consider merging with a company of similar size? Is there anyone out there that's appealing to you?
Not really. There's some private companies that I think are interesting for us. I don't think I can ever say no. Like, again, this is really back to this. If I look forward over the next 2 to 3 years and think about what this cash flow per share and what our shareholders own today, including me, and what I think the value is, I think anything that's accretive and interesting is open for discussion. It's not there's no blind spots there, but no, I don't see anything that's sort of a natural fit in the short term. But other than some of these, there's some interesting private companies that have some assets that I think are a good fit.
Okay, great. I think we've covered off everything. We look forward to getting your budget when it comes out. If anyone has further questions or would like a meeting with management, they can certainly contact me at jessica@adcap.ca. And thank you, gentlemen, for your time. Really appreciate it.
Great. Thanks, everybody, for taking the time to hear the story. Appreciate that.
Okay, thanks.
Yeah. Thanks, guys.
Okay, bye.